This is Chip Maxwell, and you're listening to the Retire Smart podcast with David Brooks. Zero fear in the markets, seasonal sell-offs, and Jackson Hole patterns. David explains what these indicators might mean for investors right now. The conversation then spans hiring slowdowns, tax flight, global policy shifts, and ends with a deep dive into why annuities are gaining traction among wealthy investors as part of proactive tax planning. Well, David, we are going to talk about high net worth people gravitating to annuities, but we have a few items to hit before that. Zero fear in the market makes me fearful. Were you practicing some Zen there, or what did you mean by that?
Yeah, I posted that on what's called the VIX, a volatility index that measures fear, and the lower that goes, the less fear is perceived in the market. Historically, when that gets down around 13 or 14 score, that usually is when nobody's looking for something happening and just something all of a sudden does happen. And ironically, I posted that, and the next day we had, over 1% moves down in all the major indices, et cetera. And so it's just telling you, when there's no fear, that's the time to maybe be cautious, right? Because something may come out from left field or something may expose it. Now, we're recording this show a little early this week on Tuesday. Wednesday of this week, which by the time you hear this show will have already happened, NVIDIA, one of the most important earnings numbers we'll get, will have reported after the closing bell on Wednesday, and that will really set up if September, are we going to see the historically, and September, just historically is the worst performing month in the S&P 500. Are we going to see a sell-off, or at least just a kind of a pullback, which also, ironically, historically happens in the first year after a presidential election? This seems to be the malaise time of year. Again, I just studied data. Doesn't mean it's a prediction or going to happen, but things we're paying attention to.
Well, speaking of studying data, you noted that at the beginning of this week, the market started down, and you posted a chart. You shared with the team a chart saying, last several years post-Jackson Hole. Notice this pattern, not necessarily prediction. First, you better describe, what do you mean, this reference to Jackson Hole, and what are we seeing in this chart?
So every year there's a major meeting at Jackson Hole where the elites of the financial world, if you will, come together. And the president of the Federal Reserve always gives a speech here. And it's one of those where he's kind of laying out what they think they're seeing for the second half of the year. So the chart, for those you can see it, what we did is laid out basically the last 7 Jackson Hole events, and
there's a dip every time.
Yeah, ironically it is. Again, that causation is not and correlation are not the same here. But again, if we don't study history, we're certainly doomed to repeat it, right? I loved this type of data. Not that I'm saying it's going to happen, but hey, what if it does, right? So here's something to pay attention to. And why does that happen? Well, typically when the Jackson Hole meeting happens, we're referencing going into the fall. The earnings season of the second quarter typically is just finished. So all the news that can move markets higher typically goes away, and we seem to have a little bit of a fade. And again, it's just data. So pay attention. If you have too much risk in your portfolio, it may be the opportune time to get someone to analyze that risk and maybe make some allocation changes, slight shifts to de-risk your portfolio, so that if the market were to correct 5, 7, 10, 12, 15%, maybe you don't have to experience the entire drawdown.
David, I'm going to hit you rapid fire here with 4 items in a row, and under the Economics 101 heading. We do this periodically, and you shared this with the team last week. New York Post headline: New York City companies all but stopped hiring in the first half of the year. Why do we think they've stopped hiring?
Well, you have the political environment in New York is such that the next mayor, which the election will take place, I believe, November 4th, is most likely, it's a high probability, like 80% right now, will be a full-blown socialist. And so companies are realizing, wait a minute, this is not going to be good for us. So they just, never mind, we just won't hire anybody. And you're going to see New York City go through some economic pain it has not experienced since pre-Rudy Giuliani. If you remember, New York was in dire straits in the early 80s, and crime, things got out of control. And they had to put their foot down, and they cleaned. Times Square, I remember going there with my dad. My dad had a couple of different businesses, but we used to go to the Diamond District, which is not too far off of the Midtown there, to buy some things that they gave away in their business, and diamond tennis bracelets. My brother Luke's probably smiling remembering that. But anyway, I remember going there, and literally I would have to hold my dad's hand. It was not you would not walk your kids in Times Square. Not the Times Square you see today if you've been there in recent years, right? And Rudy Giuliani, and they put in policies to clean it up, and tourism came flooding back to New York City, and they boomed economically. And right now they're headed the other direction. So anyway, that's just word of the wise. Be careful.
All right. Well, speaking of heading the other direction, from the Financial Advisor website, the headline is How Advisors Are Helping the Wealthy Flee New State Taxes. How many times are we going to keep seeing this scenario play out?
And that's exactly right. These advisors have a job. If you live in a high income tax state, New Jersey, California, Hawaii, New York, and many others, frankly, advisors have a fiduciary obligation to help their clients understand their tax liability and what moves they could make. And there's several of them. They can use some different investment vehicles to defer taxes for a few years. They can make some shifts. They can move their residency. As we've talked about, money will get up and walk away. We'll post the article. It's a pretty interesting read.
Well, and in case people aren't getting the message, there's a statement out on social media now from Marcus Lemonis. I hope I'm pronouncing his name correctly.
That's correct, yep.
He's the executive chairman of Bed Bath & Beyond. And David, this isn't usually done. He just blasts the state of California for regulations and tax policy and says, we can't do business here.
Okay, so there's a show, or at least there was a show called The Profit on CNBC many years ago. Marcus Lemonis was the host of that show. He would go in and potentially invest in your business and turn it around, something he's a specialist at. He's also the CEO and major shareholder of Camping World, right? And you may have seen the flag controversy there. They put up a giant American flag at every location, and one such city said, you can't have that flag. And he said, we'll just pay the fine. We're not taking the flag down. But he blasted this, and then current governor and presidential hopeful Gavin Newsom blasted back. Oh, is this the company that went bankrupt? Just so we're clear, Marcus Lemonis' company, Bed Bath & Beyond, is not the Bed Bath & Beyond that went bankrupt. They bought the name and the name only. That company did go bankrupt and completely out of business. This was the former Overstock.com that he's the chairman of, that changed its name to Bed Bath & Beyond and is basically mainly selling online, and now they're just now starting to open retail locations. But
Newsom
they are not.
Steps on a rake again?
Yeah, and they are not going to. And so, anyway, it's been a Twitter spat, fun to watch. But they are not going to open stores in California because it's just an environment. They won't defend crime, so people will come in and walk out with $900 worth of stuff. Oh, that's not prosecutable. And people are just done with the madness. So your money and wealth are going to migrate where they're treated fairly, period.
He made it very clear. We'll still service California customers online, but we are not going to set up shop in California.
Well, I believe there's a better way, and I think there's no better argument of that than our friend who is now present in Argentina, right?
Well, that's our next story. You mentioned this before. I know you've been itching to get out this. Javier Milei, he of the chainsaw in Argentina, and we've got some data now. We've got some distance. We've got some runway for the Milei presidency in Argentina. What are we seeing, David?
Well, everything is working out in his favor. So inflation has dropped, right, by 15% or more on almost every category. The poverty rates have skyrocketed to the bottom, and it was not skyrocketed, but plummeted. And Argentina is now a global champion of growth, and their GDP has been on fire growing. So all the metrics you want to see, because he does not have to go through the same partisan congressional malaise that we do. Now, look, I'm not asking for a dictatorship in any way. People think Trump is already authoritarian. But we need Congress to get their act together and start gutting the federal government. Smaller government leads to economic growth, and capitalism rises all tides. I mean, we've seen it throughout history. Nothing has gotten more people out of poverty in the world than capitalism.
Rising
and nothing has murdered more people than communism and socialism, and the data just proves it.
Well, there's our economics 101. You do things the right way, you attract people in business. You do things the wrong way, and you drive them away. All right. Now, finally, David, we arrive at this headline that you sent to me. Why high net worth investors are paying more attention to annuities. So an annuity may or may not play a role in a properly ordered portfolio, but what's going on here?
So for the high net worth person, you need to understand is when you put money into an annuity, and there's many types of them, okay? So, and we're not recommending an annuity or anything right now. Just understand that an annuity is simply a vehicle that tax shelters your money the time you're in it. So if you happen to be a high net worth individual and have high income, but that income is going to change, maybe you're going to sell a business or exit a business 3 years from the future, 5 years, 7 years in the future, and you have $2 million in a trust account kicking out $50,000, $80,000 in taxable dividends every year that you don't need or want, there's a couple things we can do. We could restructure the portfolio into more growth-oriented assets that don't send out taxable dividends, or we could shift some of those assets into an annuity. And again, there's many types. The article references a variable annuity. Now, we're not big fans of variable annuities because they usually come with a kind of high fees, and we're very fee conscious. But
fixed index annuity, I know we like those.
Yes, because they have zero fees in this situation. Exactly that. So and they're going to be tied to some form of gain of the market if it goes up. So if the S&P 500 rallied up 20%, you might get 8% of that or something in a fixed annuity. But that growth is not tax chip like it would be in your brokerage account. So for a high net worth individual that we're trying to do other tax strategies, right, or we're waiting to an exit of a large business or a farm sale or something like that, in the meantime, we might want to place some of those assets in there where those dollars grow and we don't have to pay any taxes on them, lowering your current tax liability that we can maybe compile with other tax saving strategies, a la, for instance, a Roth conversion. If I could shave $80,000 to $100,000 off a high net worth individual's taxable income every year and then do a Roth conversion for that same amount, I've not increased their tax bill, but I've increased their net worth typically, right? There are so many facets of this. That is why proactive tax planning is so important for a well-designed retirement plan. And you don't have to be a high net worth investor to benefit from that proactive type of planning.
Thank you for listening to the Retire Smart podcast with David Brooks. If you want to learn how to generate lifetime income, reduce your tax bill, and maintain your lifestyle in retirement, visit retiresmartpodcast.com. And make sure to subscribe to keep up with new episodes every week.